right, so today we're going to talk about rental cash damming, and I'm going to take you through the whole process pretty much, and explain how it works and the steps you take to actually implement it if you have a rental property. First things first, like with all Smith Maneuver products, we have to have that readvanceable mortgage. I'm going to cover that super quickly just to make sure everyone knows what it's all about. With a regular mortgage, say you start with about $500,000. Over time, you paid off to $400,000. That amount, that $100,000 you paid off disappears, then $100,000, and eventually zero. You don't get to keep the money, access to the money that you've already paid off. With a readvanceable HELOC, we're going to attach a HELOC to that mortgage. And when you pay off $100,000, you're going to have $400,000 of your mortgage left, but you're also going to have $100,000 of HELOC room. So your total amount of borrowing room always stays the same. So if you pay it down to 400 or down to 100 or down to zero, the rest of that space is going to be occupied by HELOC space. It doesn't mean you have to use it, but that's the product that you use. And in this case, or in many cases with Smith Mover, we do actually use it to make sure we're taking advantage of the tax efficiency that comes along with it. All right. So with that covered, that basics covered, let's talk about rental cash damming. So rental cash damming, obviously you're going to have your primary residence that's going to have a mortgage, and you're going to have a rental property that's generating an income of some sort through rent. To start, we're just going to talk about the primary residence. So in this example, we're going to use some made up numbers, but say your mortgage payment is $1,200. You take the mortgage payment. Of that $1,200, some is going to be interest, some is going to be principal. So $700 in this case is going to interest, represented neatly by this trash can. $500 that's remaining is going to go towards reducing your actual principal. So you can see that up here. $500 of that mortgage money goes in, and it brings your mortgage amount down by $500. Now, same with your rental income. Your rental is, or sorry, your rental property is going to generate some rental income. In this case, we're going to say it generates $1,000 of rental income. So you take that rent that you receive from your tenants, and you're going to apply it directly to your primary mortgage by means of prepaying it. So now you can see the primary mortgage has gone down by 500 from our mortgage payment and another 1,000 from our rental income. Okay, step by step, we're going to make this super simple. Now we're going to represent the HELOC growing. So we've made this $1,500 worth of payments towards our principal of our primary mortgage. With that, our HELOC amount is going to grow by the same amount, $1,500. So now we have $1,500 available in our HELOC. Okay. What we're going to do is we're going to borrow that full $1,500 in this case. Okay. It's going to go into what's called a clearing account. Now, this is nothing special. We just use it for tracking purposes and organization. It's basically just a checking account, and you put the money in there. This is a dedicated spot for any money from our HELOC that's going to be tax deductible to stop first. So it goes into our clearing account, $1,500. Now, if we've been doing this for a while, there's going to be HELOC interest payment from all the money that we've borrowed. So out of that $1,500, we're going to take our interest, which in this case I've put at $10, and feed it back to the HELOC as a payment. So we have 1490 left. We're going to take that whole 1490 out of the rental clearing or the clearing account, and we're going to transfer it into a rental clearing account. This is another step that's recommended just to make the expenses for your rental property specifically really visible and clear to track. So you go from this clearing account, which is just a checking account, to this clearing account, which is also just a checking account. And then you're going to pay your expenses. So things like your rental property mortgage is a big one, and any other rental property expenses you have. So things like maintenance fees, things like repairs, property taxes, all these expenses that allow you to have this investment would be considered an expense that you could claim or could pay for with this kind of money. So now, as you can see, your rental income is still paying your rental expenses. But what if you're cash flow positive? So if you're cash flow positive, you're going to take that rental income, put it in like this, and actually we're going to put this up. That's fine like this. If you're cash flow positive, you're gonna have $1,500, and say your expenses are only $1,000. So now $1,000 is going to get split up between your rental mortgage and your rental expenses, 800 and 200 in this case, and you have 500 left over. Now you have money left over to put towards your future investments. You can invest in anything that has the potential for an income. So any kind of stock or ETF that produces a dividend would be a good qualifying investment. You take that $500, put it in there, and month over month over month, you're actually going to grow and grow. Okay, and that continues going on. If this is only $800, and this is say only $600. That's fantastic. So now you have $700 left over. There you go. And you can invest more. Okay. And it goes both ways. If it's more expensive or less expensive, you just put more or less towards investments. Or you keep the $700 as in your HELOC and not use it as well. That's another option you can take. But for long-term wealth, we want to maximize as much as we can. So that's the general idea of the strategy. So I'd like to go over, I think I'm going to stop sharing and reshare an actual scenario with you. Okay. So this is our rental cash jamming example. So first of all, the mortgage, these are all, again, made up numbers, but we put 600,000 at 25 years and 4%. It doesn't matter really to get $3,200 payment. We have a HELOC rate of 4.95. That's all we need to know really. Okay. So this is our rental property information. So on a rental property, which I've named just 123 Main Street, we're going to assume a property value of 600,000, mortgage balance of 480,000, a rate of 4.5, and a 20-year amortization, which gives us a monthly payment of $3,025.94. Now, on this property, we're just going to, for example, say that we have a monthly rent that we collect of $38.75, $3,875. Okay. I've put all the example expenses in here. So say we have yearly property taxes of $3,000. We don't have a maintenance fee. Say it's a standalone building. Utilities of 250, insurance of 200, and other expenses of 149.06, just to make the math a little cleaner. With all these expenses on average, and the rent that we collect on average, our cash flow is going to be exactly zero. So we're not profitable. The only thing we're doing is covering our expenses with the amount of rent that we have. And so with that, we're going to do a cash flow dam rental. We're not bringing in any money. We're not taking out any money. We're just cash flow neutral. So let's look at how that affects our results. Now, these are the results on our primary mortgage, okay? Not the rental mortgage, our primary residence mortgage. If we do this, this is what our normal mortgage looks like. Over 25 years, we pay it. It eventually comes down to $0 and we own our house outright. That's how that works. With this strategy, the rental cash jamming, our non-deductible debt, so the debt that we can't claim against our taxes, the interest we can't claim against our taxes, is going to come down much more rapidly, all the way down to 8 years. So by the time 8 years has passed, it's going to be a completely tax efficient loan instead of a non-tax deductible mortgage. And conversely, our deductible debt is going to grow to the same height. So it ends up almost close to where we would have been anyways at the 8-year mark, but now that $457,000 is completely tax deductible loan. So the interest we pay on that is claimed against our income. And from that point on, when we put the money towards the strategy from then on, our entire loan amount goes down, down, down until we've paid off entirely in 21 and a half years, say. Just probably less than that, 21 and a third years. So we've saved 3.5 years, 4, almost 4 years off of our mortgage, just by routing our money slightly differently and making our loan tax efficient. But what if we had a rental surplus and we wanted to increase our long-term wealth? Let's look at what we can do there. So we'll go to our rental property and just say our expenses are less. Let's say our property tax is only 2,000 a year, 2,000 in a year. That makes us only 83, and we'll just lower these to make it profitable for us here. Insurance is only 150, and then we'll just put this at 100. Okay, so now we're profitable. We can see our cash flow right here is $232 a month, which is pretty conservative. It's not a whole ton of profit, but it is slightly profitable. What we're going to do now is two things. First we got to go accelerators. We are going to turn on our plain Jane. This allows us to start worrying about more net wealth and less about just reducing our debt. So now when we have the plain Jane on, we're using that extra cash to invest, to pay down our mortgage, and to invest it in our appropriate assets. Now, one thing, there's a caveat here that I'll go over in a minute. So this is how the strategy changes. So let's just do it the same way we did the last one. Here again is your regular mortgage. From now until 25 years from now, you pay, you get down to zero. That's it. Now your non-deductible mortgage is going to go down to zero at 8, pretty much the same, and your deductible debt is going to go up until year 8. Now you notice when we did it the first time, the deductible debt was just about where the green line is, the regular mortgage. Now the deductible debt is going up to the full amount of our regular mortgages today. So we're keeping our borrowing room at 600,000 and 600,000 the entire way across. And the reason for that is because we're using that money. We're utilizing all the extra money to build our investments. We don't want to pay that debt down. That's good debt. So let's look at our investments. Here we go. So you can see over time, the red line is all the money that we're putting into investments. We're assuming, I believe, an 8% return, but let's double check. 8% return and a 40% marginal tax rate. Over time, it grows, grows, grows. And at the 25-year mark, where we would have only owned our home and nothing else, at the 25-year mark, we now have almost $1.5 million worth of investment assets to our name and a debt of $600,000. Now, if we wanted to sell everything at year 25 exactly, pay the capital gains tax and pay it off our loan, the taxes would obviously reduce it. Let's see. Currently, the difference is $887,000. We could probably knock a bit off that depending on the exact calculation for our capital gains at that time, which was is too complicated to calculate on the fly here. But say you walk away with 100 or $150,000 less than that, you're still coming out $750,000 up from what you would have by not doing this strategy. So that's an incredible $750,000 up by just using your money slightly differently than you were before. Okay, so that's how the strategy works, and that's why I'm such a big fan of it.